Moving on then to the private banks, and now another one jumping on the bandwagon. It's private sector lender HDFC Bank. They're planning to raise close to 13,000 crore rupees, and this is going to be via the issuance of ADRs. Nikunj, clearly joining this growing list of Indian banks that at this time have been looking to shore up their capital.
And this is HDFC Bank, Awan, they don't have any capital problem. If at all, they're sitting at surplus capital. HDFC Bank issue will sail through, because typically global investors, they wait for these moments when a big bank like HDFC Bank, when they come out, hit the market, and when they're raising capital. But remember, they're raising capital not when the stock is at 1500. They're raising capital when the stock is almost at 1000 rupees. They're raising capital at a time when they essentially have a lot of surplus capital. So the question you got to ask yourself is that why are they raising so much of capital? Well, this is not growth capital, but this in a sense is a survival capital. When I say survival capital, they are raising cash when it is available. Global liquidity conditions are benign. Their view on the world clearly could be that, what if things take an ugly turn on a liquidity front and on a global front and an economy front, and they may be using a lot of capital in order to, or if NPA cycle rises, they may be using a lot of capital to protect their balance sheet. What are banks doing, Avan? They're simply following a simple mantra of keeping their balance sheet afloat, which is make your balance sheet strong, have enough cash in your balance sheet, so whenever the cycle turns, you are able to really lend, or if the NPA cycle becomes worse, you have capital to take care of it. However, in a bull market, typically when banks have historically raised capital, markets have celebrated that because that is considered to be growth capital. This is not the time when you are looking at big growth coming back or big credit offtake coming back, which means right now markets would view this as additional paper supply coming out, and this is coming at a time when generally banks are reducing, or investors are reducing their exposure to financials. So it's more like it's more like a double squeeze, or you're stuck between rock and a hard surface. One side, institutional investors were reducing their exposure down, and on the other side, banks, which in a sense are raising capital in order to strengthen their balance sheet. So a lot of supply is going to be coming, has already come, and will continue to come even from the private banks, and that in a sense could really jam the market, at least in the future.